Welcome to the Dev Journal. We are moving past the era of mere experimentation into a period of massive industrial scale for artificial intelligence. When we see investments like the $100 billion partnership between Amazon and Open Artificial Intelligence, the focus has shifted toward building permanent and agentic digital infrastructure. We are starting with a deep look into the leaked source code from Anthropic. This massive data dump contains over 510,000 lines of code that detail the internal logic of their artificial intelligence agent architecture. It is an unprecedented look at how the next generation of software will act without constant human oversight.
Sloan, that architecture is certainly impressive, but the hardware demands are where the real story lives. I am analyzing the transition NVDA is making toward their Vera Rubin chips, with technical indicators sitting at a 6 out of 10 confidence level. We are investigating if this is the moment for a significant technical rebound.
From massive capital deals to the very lines of code that define our future, we have a lot to unpack today. We are tracking the shift from hype to hard engineering as the industry prepares for a total transformation of the development lifecycle. Our first deep dive into the Anthropic leak starts right now. The 60 megabyte source map file, discovered in the Node Package Manager package version 2.1.8, reveals an incredible commitment to software durability. With 512,000 lines of TypeScript spread across 1,903 files, we see a blueprint designed to justify massive enterprise trust in artificial intelligence. What really stands out in this architecture is the specialized verification agent, which operates on a philosophy of trying to break every single line of code it produces. By enforcing mandatory builds and adversarial probes, they are ensuring that artificial intelligence-generated software actually meets the rigorous standards of professional development teams. The system also handles long-term project memory with a brilliant process called dreaming mode within the Kairos framework. During periods of low activity, it compresses raw session logs into structured markdown, allowing the agent to maintain a deep understanding of a project history without suffering from the common problem of token explosion.
Sloan, while those reliability layers are impressive from a product standpoint, the sheer volume of code in those 1,903 files suggests a massive complexity tax. Maintaining 500,000 lines of code just to manage an agent is a significant engineering burden that could eventually slow down their development velocity. I have deep concerns regarding the performance bottlenecks hidden within that 14-step tool validation pipeline. While a multi-agent swarm, including a plan agent and an explore agent, sounds robust for safety, each additional step adds latency that becomes incredibly expensive when you are running these operations at a massive scale. The most effective engineering choice in this leak is actually the system prompt dynamic boundary, which separates static instructions from changing context. By isolating those components, Anthropic can maximize application programming interface caching and keep operational costs from spiraling out of control as the agent handles increasingly complex and lengthy developer tasks. We also see a very strict security posture through their fail-closed tool factory, where features like concurrency safety and read-only permissions default to false. This requires explicit developer overrides for any high-risk actions like deletions, proving that they are prioritizing system integrity over a frictionless user experience. This tension between complex software safety and operational efficiency highlights a broader challenge in the industry as we move from the high-level architecture of these agents to the underlying memory optimizations required to run them effectively. We should examine how systems like TurboQuant achieve 6 times compression for better inference.
TurboQuant is reshaping how we think about the cost of long conversations by slashing memory requirements by a factor of 6. When you look at a typical 2,000 token session, we are seeing the memory footprint drop from 1 gigabyte down to just 150 megabytes. This creates massive room for sustainable product growth. every single token in a 32-layer model produces roughly 262,000 numbers for the key value cache. Without this kind of optimization, the system scales rapidly to consume many gigabytes of video random access memory. Reducing that burden is essential for any company trying to maintain high performance at a global scale. The real win for businesses comes from the increased number of concurrent users each graphics processing unit can handle. By enabling longer conversation windows that would otherwise exceed physical hardware limits, providers can offer much deeper interactions without the massive infrastructure costs that usually come with scaling advanced large language model applications to the masses. As long as the user does not notice a drop in quality, this precision trade-off is easily worth the massive efficiency gains. It allows for a level of accessibility that was previously impossible for smaller firms. Vance, how do you see the actual engineering behind this 3-bit per value quantization working out in practice?
Looking at that 3-bit per value quantization, the scale plus codes approach is actually quite clever. They are effectively squeezing data down by representing large vectors with small integer codes and specific scaling factors. This is a calculated gamble that prioritizes saving memory bandwidth, which is the real bottleneck compared to raw mathematical operations. To keep this accurate, they use a lightweight correction step that focuses on preserving the relative ordering of attention scores rather than exact numerical precision. This assumes the model only needs to know which parts of the context are most important. I wonder if this heuristic holds up across 32 layers during highly complex reasoning tasks. If the attention scores shift too much, the reasoning capabilities of the model could degrade in ways that are difficult to measure through standard benchmarks. Achieving a 6 times reduction in total random access memory usage is an engineering feat, but we have to ensure the intellectual integrity of the output remains intact during these compressed operations. Moving from these sophisticated memory optimizations for text brings us to a whole new set of resource challenges. We need to shift from memory optimization for text to the high bandwidth requirements of native multimodal models, like the new release from Alibaba that handles real-time audio and video interaction through a native multimodal architecture.
Alibaba is setting a new global standard with QN 3.5 Omni, which has already achieved state-of-the-art results across 215 specific subtasks by outperforming Gemini 3.1 Pro in general audio reasoning. This model establishes itself as a powerhouse for translation services across 113 different languages. What really moves the needle for everyday users is how this system handles native turn-taking and intent recognition. It can actually distinguish between a simple back-channeling sound and a semantic interruption. This allows for a full duplex conversation that feels remarkably fluid and responsive, making digital assistants feel more human than ever before. The sheer scale of the training here is breathtaking, utilizing an audio transformer pre-trained on over 100 million hours of audio and visual data. This massive foundation allows the model to grasp subtle acoustic nuances that traditional systems often miss. It opens up incredible possibilities for global streaming services looking to automate translation. Vance, when you look past the impressive conversational polish of this model, how are they actually managing the massive throughput required for real-time video processing? I am curious if their architecture can truly sustain 720p video feeds without hitting a massive performance wall as the context window expands.
The secret to that video performance lies in their unified thinker-talker architecture, which utilizes a hybrid attention mixture of experts. This setup allows the system to process 400 seconds of 720p video at 1 frame per second, while managing a massive 256,000 token context window effectively. To ensure the voice side remains stable during these heavy visual tasks, they developed the adaptive rate interleave alignment technique. This method dynamically aligns text and speech units during the generation phase to prevent the stuttering or instability often seen in multimodal systems. which is critical for maintaining the illusion of a seamless and uninterrupted human conversation. While the engineering is sound, we cannot ignore the staggering data moat Alibaba has built with those 100 million hours of pre-training. Very few organizations on the planet can replicate that level of multimodal data ingestion, which creates a massive barrier to entry for any firm without specialized hardware and deep data repositories. The technical requirements for running these massive models are intense, but they pale in comparison to the financial structures supporting them. We need to shift our focus from these specific architectural optimizations to the massive financial capital required to host and maintain them. This brings us to the recent billion-dollar deals we are seeing.
Think about the staggering scale of the new partnership between Amazon Web Services and Open Artificial Intelligence. This historic $100 billion compute agreement stretches over 8 years and signals a massive strategic shift. For Amazon, this is much more than a simple contract. It is a definitive long-term land grab in the cloud space. To support this unprecedented demand, Amazon has ramped up its capital expenditures to a jaw-dropping $131.82 billion. While that number is intimidating, top analysts at Tigris and J.P. Morgan see it as the fuel for future margin expansion, raising their price targets to $315 and $280. Looking at the underlying business health, we see a robust 50.29% gross margin. This suggests that their core services are incredibly profitable before the heavy infrastructure costs hit the ledger. Even though the net margin sits lower at 10.83%, it reflects a calculated bet on future dominance.
Sloan, looking at those same spreadsheets, reveals a much more precarious situation for shareholders today. That aggressive spending has essentially gutted their free cash flow, leaving them with just $7.70 billion. It is a massive drop that highlights the extreme financial pressure required to maintain this leading position in the industry. This strain is already showing up in the quarterly results where they miss the earnings per share target. Reporting $1.95 compared to the expected $1.97 might seem small, but it proves that even a titan like Amazon cannot ignore the immediate costs of building this infrastructure. The 39.5 percentage point gap between their gross and net margins is particularly revealing about their current trajectory. Amazon is effectively transforming into a high-end hardware utility. Maintaining these massive server farms and specialized chips is incredibly capital-intensive, leaving very little room for error if the demand fluctuates. Beyond the internal margins, we see a neutral technical setup with a relative strength index of 46.07 and recent insider selling totaling over $14.69 million. This data suggests a more cautious outlook for the next 21 days, as the market weighs these long-term gains against the immediate financial headwinds.
Vance, while the cloud providers are spending these fortunes to stay competitive, the attention naturally shifts to the companies actually manufacturing the hardware for these massive data centers. We should move from the customer of the chips to the manufacturer benefiting most from this massive global infrastructure cycle as we look at NVIDIA. NVIDIA is showing a fascinating contrast between its massive market footprint and its current technical position. While the company maintains a staggering $4.24 trillion market capitalization, its relative strength index has dipped to 38.10. This suggests the stock is technically oversold, despite the underlying business strength. That disconnect becomes even more striking when you look at the fundamental performance driving this engine. NVIDIA recently reported 65.47% year-over-year revenue growth and generated $96.68 billion in free cash flow. They are maintaining a high net margin of 55.60%. Optimism is building around the aggressive price targets coming from major analysts like those at Wedbush. They recently upgraded their target to $300, which is significantly higher than the current price of $174.4. This reflects massive buy-side expectations, as NVIDIA continues to exceed every financial goal. The company is now strategically reallocating its manufacturing capacity at Taiwan's semiconductor manufacturing company to prioritize its next-generation Vera Rubin hardware. This move is designed to meet the relentless global demand for artificial intelligence infrastructure. Vance, how do you see the market interpreting this transition, given the high volatility we are seeing?
The market interpretation hinges on that forward price to earnings ratio of 15.69. When you compare that number to their 64.75% year-over-year earnings growth trajectory, the stock looks undervalued. However, managing the shift to Vera Rubin hardware while maintaining these margins is a complex engineering and logistics feat. We cannot ignore the high beta of 2.38, which indicates the stock is prone to amplified volatility. Investors need to brace for a wild ride as the market digests this hardware transition. There is a lot of noise to filter through before we reach the May 20th, 2026 earnings report. This transition period is critical because any hiccup in the Taiwan semiconductor manufacturing company pipeline could derail that projected 5% plus upward move. While the guidance for the first quarter of 2027 exceeded expectations, the technical setup remains precarious. High beta means macroeconomic shifts will hit NVIDIA harder than most. The reliance on these specialized chips creates a unique set of financial pressures that differ greatly from other sectors. It is worth contrasting the high volatility chip market with a specific, high-stakes acquisition in the biotechnology sector. We should look at how Centessa Pharmaceuticals is navigating a sideways price earnings to growth ratio following a major announcement.
Eli Lilly is making a massive statement in the biotechnology space with their announcement to acquire Centessa Pharmaceuticals for $6.3 billion. This deal is centered entirely on a lead program called ORX750, which is a promising treatment currently being developed for sleep disorders like narcolepsy. What stands out to me is the sheer premium being paid despite Centessa reporting significant financial losses. The company currently shows a negative net income of $235.76 million and a negative free cash flow of $142.09 million for the most recent period. This acquisition demonstrates that major pharmaceutical players are willing to completely overlook deep operational losses when they see a high potential asset. With Oppenheimer setting a price target of $62, the long-term vision for this sleep disorder drug seems to outweigh the immediate fiscal burn of the business. The stock has already surged 46% to $39.72, which sits just above the $38 cash floor. Vance, how do you interpret the specific financial instruments being used here to bridge such a significant valuation gap for an unprofitable company?
The most telling part of this arrangement is the $9 contingent value right being offered alongside the base price. Currently, the market is only pricing in approximately 19% of that potential value, which suggests a massive amount of skepticism regarding Centessa actually hitting its future clinical milestones for the drug. From a technical perspective, the stock is looking extremely overextended with a relative strength index of 73.06. This overbought status typically signals a period of sideways consolidation, especially since the immediate upside is being capped by arbitrageurs who are working to lock in the narrow deal spread. We also have to consider the bearish divergence created by insider Karen Anderson, who recently sold $1.2 million worth of stock. While there is a 472% surge in bullish call option volume, the insider selling suggests those closest to the engine are taking profits now. We are essentially seeing a 5-day sideways price earnings to growth ratio as the market waits for more clarity on the closing timeline. This situation serves as a perfect final wrap-up on our theme. Today, Regarding the massive capital deployment, we are seeing across both the technology and healthcare sectors as the show concludes. Considering the 510,000 lines of code leaked from Anthropic, alongside that $100 billion Amazon commitment, the engineering effort is finally meeting the capital it requires. We are moving past the experimental phase and into a world of massive agentic architectures that require serious hardware to function.
That shift from experimental projects to industrial infrastructure is the defining story of our current moment. We are seeing major players stop asking what these models might do and start committing the billions of dollars necessary to build the physical and digital foundations. It is no longer about the potential for change, but the reality of deployment. As we watch these massive systems move from the research laboratory to the literal foundations of our global economy, the real challenge will be maintaining human oversight in an increasingly automated world. Thank you for listening to the Developer Journal. We hope these insights help you navigate the complex intersection of technology and capital in your own work.